there's a lot of criteria on choosing great companies. That first one is that they're at least 100 years old. I'd like to see that because I want to see what happens during good times and bad times, recessions and depressions. And, we've seen world wars during that time. So I think that's really important to see when interest rates are high, low, the market's up or down. How do they handle that? Money can be complicated. Let a nerd help you. We're here to demystify the complex nature of money by getting you answers from financial nerds and whiz kids. Welcome to Ask the Money Nerds, a weekly segment of the Wealth Labs podcast where we answer your most pressing money questions. If you watched any of my videos before and learned how to cut out the middleman when it comes to your finances so you can boost your return on your savings, or how to protect your money from financial predators, or how to secure your returns rather than rely on an unpredictable stock market, or even keep access to your money while having tax advantages along the way, and you want to know the best companies to choose to set up something called cash flow banking, then pay close attention. First, when you put your money in that bank, they take a portion of that money and they put it in a reserve account. Part of the reserve account can be put in an insurance contract. This insurance contract is nothing like most life insurance policies. It has to be set up properly for you to minimize the costs, right? Have to lower the commissions and mimic, in your situation, what the banks are doing. Unfortunately, way too many of these policies are just really high commission and really low cash. It has to be the type of company that performs properly. There has to be very high early cash value, great dividends, a good guaranteed interest rate, and plenty of flexibility. These factors narrow down from thousands and thousands of companies to maybe a couple dozen. I'll unveil which companies to choose, which ones I certify, and personally create content for. All right. I'm going to let you ask the question, Chief of Staff Stola.
Okay, let's dive in. It comes in from Justin today. And he says, I'm wondering what insurance company that you recommend going through for whole term policies and what your relationship to Garrett Insurance is. I've heard you say that there are a lot of insurance companies out there that offer security through a long history, maybe over 100 years. So what is there to worry about with younger companies? And are their planned death benefits still guaranteed if they go out of business?
Younger companies are like really young kids. Like I took my 15-year-old to start working with him on driving. And when you just put someone behind a wheel for the first time, it's a scary thing. So that's one thing about the younger companies. There's a lot more to it. But let me address this really directly. First, there's a lot of criteria on choosing great companies. That first one is that they're at least 100 years old. I'd like to see that because I want to see what happens during good times and bad times, recessions and depressions. And, we've seen world wars during that time. So I think that's really important to see when interest rates are high, low, the market's up or down. How do they handle that? The minimum guaranteed interest rate I look for is 4% because, I want to make sure that if things don't go according to plan, which a lot of times they don't, there's something you can count on. But I also want companies that always have paid a dividend throughout their entire existence because that means that they were able to pay even when everything else wasn't working out. And there's something in these types of policies called paid up additions, PUA. Paid up additions are where you're putting in extra cash above the base of the policy and it fuels more cash value and can even increase your death benefit. I want it to be flexible where you could put some money in and then another month maybe put more money in or another month put nothing in because I know that cash flow isn't always predictable. And we've seen, especially during recessions of 2000 to 2002, 2008 to 2010, and even what we're facing right now in 2020, that flexibility can be instrumental to make it to the other side. So I also prefer mutual companies over stock companies. And a mutual company is owned by the policyholders. Where a stock company is just like it sounds, it's on the stock market. So if they have earnings or they have dividends, they're going to give the policyholders some of that, but they're also going to give stockholders some of that. And if you've watched any of my other videos, I'm not really big on stock market companies because there's something called shareholder value. And I feel like a lot of times shareholder value takes such a huge priority because it's a fiduciary responsibility, meaning that's what they have to look out for, that many times they're not thinking about employees or customers. And, we've seen a lot of just terrible things happen in the public market. So I prefer a mutual company as well. So hopefully you get enhanced or better dividends. So that's the very first part on like choosing a company as far as criteria. Yes. Now I could even list some of the companies.
Mm-hmm. So one of the points that you said was a minimum guarantee of 4%. How does one determine that that's
It's contractual.
Okay.
It's in the contract.
Okay. But are there fees that they need to look for in those plans just like they do 401ks? And how do they determine in the end they're actually going to get the 4%?
That's a really good question that unfortunately the insurance companies don't do a good job at answering. Mm-hmm. These policies are not unbundled. So it's hard to know exactly what the costs are. You just have to look at what the net return is when you look at the cash value. So you compare multiple companies and illustrations to kind of analyze that. And that's why it's important to have a certified cash flow banking specialist. So Garrett is a company that is mentioned in this question. So two gentlemen, Ryan O'Shea and Dale Clark. Dale Clark became a client of mine in 2005. Ryan and O'Shea and I went to high school together, and he eventually became a registered investment advisor. And my firm, Wealth Factory, we had Dale as one of our financial architects for a number of years, and Ryan O'Shea as an accredited network member, registered investment advisor to help our clients analyze their investments. Well, they came together and said, what if we created an insurance company and got certified so that we could be an approved vendor, like an accredited network member? And so they built that over years. And so I create content for them and license content to them. So I actually have a profitable relationship there, even though I don't have any ownership in the company and don't tell them what to do. But at the same time, for them to get those referrals and for those, for me to create content for them has to meet the criteria of how the policy design is. And so it's been a great relationship that way. And so Garda can write with multiple companies. They're not beholden to one. Like I know some people that are with good companies like Northwestern Mutual, but a lot of times Northwestern Mutual doesn't like them writing business outside of that. And so they're putting too many people in just one type of policy. And Northwestern Mutual also doesn't like for people to borrow from their policies. They tend to have a little bit of penalty on the commissions for the agents. So even though I would love to see that policy, I think it's a good policy for people, I don't run into it quite as often. Other companies that are really good out there, like Guardian, I have a policy with. Mass Mutual is another company. I think they've hit the $1 trillion mark now. Penn Mutual, Mutual Trust, Lafayette Life, New York Life, One America, just to name a few. There's, like I said, probably a couple dozen. Those are all mutual companies. They've got good track records for dividends. They've got good guaranteed interest rate. They've got pretty good flexibility with the overfunding. So yeah, there's the answer to that. And unfortunately, they don't unbundle these and say, here's exactly what you're paying. You just have to look at what your net is. Like, what are you actually getting after expenses?
Okay. So when someone's starting out, because I'm assuming there are a lot of people who this is a new concept for, do you have any tips on what they should look for when they're navigating that new contract?
Well, I think that cashflowbanking.com is a phenomenal resource. I think on YouTube, we have so many videos. If you type in, my name and cashflow banking, that really goes through this. We've even built courses for this. Even in my book, budgetingsucks.com, I have whole chapters on cash flow banking and cool resources and even video courses that people could buy in addition to that to get more detail. But even What Would the Billionaires Do? Another book of mine goes into a ton of detail around this. Now, whether you want to invest and buy those books or whether you just want to navigate the YouTube channel, we've gone through a lot to help people really navigate this. Yeah.
I have one other clarifying question. So you said you prefer mutual over stock companies. And we know if it's a stock company, it's connected to the stock market, Wall Street. But tell us, just clarify, what does it mean if it's mutual?
Privately held. Okay. So it's not traded on the stock market. These still be really big companies, and they're owned by the policyholders. So when there's a distribution, it goes to whole life policyholders. Now, I don't use universal life policies for cash flow banking. A lot of people use index universal life, which is given a minimum guarantee and you get to participate in some upside in the stock market, but it has a variable cost ratio through what's called M&E. So mortality and expense can increase over time. And so I like to have that more stabilized and fixed with cash value and whole life, because you may want to utilize that more often and put it back in, and when good opportunities come. And so designing it right is really important. So we've covered my relationship with Garda, and we've covered a lot of the different, companies that you could use out there. But creating a certified cash flow banking, policy comes from cashflowbanking.com. And, another question that was in there though is, are there guarantees to these?
Yeah.
And so when you put your money in the bank, there's the FDIC, right? So that you've got that guarantee or that background. Well, there's state guarantee associations. And we're filming this in Utah right now, where that state association has never been tapped into for $1 when it comes to life insurance policies. The FDIC has been tapped into to the tune of billions of dollars. So looking at the stability here versus the stability of most banks are lending money too frequently. I mean, they do fractionalized where they can lend $1 more than once and those types of things.
Yeah. Okay. Let's see if we covered all of Justin's questions. Oh, are death benefits still guaranteed if they go out of business?
So death benefits right now, what's happened most of the time, if a company's gone out of business, another one buys them. But then, yes, there are limitations to how guaranteed they are based upon the state association in which state you're in and how much they're willing to guarantee. But that does give you a little bit of a backdrop. And, once again, why it's important to have these multi-billion-dollar companies that have seen different cycles, that have tons of cash reserves, and I feel can recruit the best talent because they've got the money.
Yeah.
I think it's a little bit harder on these startups, and we've seen how a lot of startups are kind of hit or miss. And, this isn't really a sexy industry. This isn't like something overly exciting that a lot of new talent is getting into necessarily. So to see a startup try to enter this arena, I mean, it just seems a little bit too volatile.
Yeah. So we know on your YouTube channel that there are a lot of people who are starting off their journey of building their financial literacy. So if someone's learning about these policies for the first time, when is a good time for them to get started? How much can they start putting into it if they don't have a lot of money? I started when I was 19
years old with $50 a month.
Okay.
So wasn't married, didn't have kids, just started somewhere, right? And then there's people that are putting, there's people doing private placement life insurance, which starts at $1 million minimum to put into it. So there's the whole gamut.
Okay, so this is a good place for people to put their money in all different places.
All right, so we've talked about mutual versus stock, old companies. We've talked about Garda and my relationship there and a better system for you to capture your wealth. And then you can use the cash that's in there anytime and still have tax advantages along the way. I think this is a better alternative to the stock market and retirement funds that lock your money away and don't provide cash flow, and is a great place to store money. And it's a much better alternative for most people than savings accounts, unless you need that money in the next 30, 60, 90 days, or maybe even a year or two. So, all right, this is Garrett Gunderson. Now you can turn your thoughts into profits and build the life you love.